Good morning, everyone, and thank you for joining us for today's webinar event entitled Demystifying Medicare, What You Should Know Now and in the Future. This is going to be a 1-hour session, and it's being hosted by Counselor Buchanan and Mitchell and May Barnhard Investments, the firm's wealth management subsidiary. If this is your first time joining us, Counselor Buchanan and Mitchell is a full-service accounting and advisory firm. We're located in Bethesda, Maryland, but we serve clients throughout the DC and Mid-Atlantic area and really across the country. So if this is your first time joining us, we welcome you. And our presenters today are Judy Barnhard and Alex Seleznev. We've had a lot of registrations, so we're looking forward to a really good crowd today, so it should be a great event. Please remember that our presenters have worked with hundreds of clients over the years on issues related to Medicare and financial planning and retirement planning. And this event is really just intended to have them share their expertise with you. So please don't hesitate to reach out if you have any questions. For those of you who submitted questions during the registration process, thank you very much. They've been shared with Judy and Alex, and they will be addressed throughout the presentation. We have a chat box available, as many of you know already, so please feel free to submit your questions during the webinar. And as you know, again, if you're familiar with our events, we'll be sending out the slides and a recording of today's session tomorrow or the day after that. So we'll also include Judy and Alex's contact information. So again, feel free to reach out. They're here to help out in any way we can, and we'd love the opportunity to work with you. All right, so let me move on to quick bio intros, and then I'm going to turn it over to our presenters. Judy Barnhard is an executive vice president at CBM, and she's a director of professional services, wealth management, and financial planning services at the firm. She's also chief compliance officer and co-founder of MBI. In her role as a certified financial planner and a CPA, Judy consults on income tax preparation and planning for individuals, small businesses, estates, and trusts. She provides advice on cash flow and budgeting, retirement planning, and risk management. And she's also a frequent presenter on tax and financial planning related topics at CBM, including at a recent webinar, Maximizing Social Security Benefits and Avoiding Mistakes, and at an upcoming webinar about the new Secure 2.0 legislation scheduled for May 2nd. Now, that session was originally scheduled for later this month, February 23rd, but we're rescheduling it. If you're registered and you haven't gotten an email about it, you should shortly. So just again, the Secure 2.0 webinar is going to be now on May 2nd. Alex Seleznev is a partner and a director of wealth management and financial planning services at CBM, and he's also the co-founder and chief investment officer of MBI. He has 15 years of experience providing comprehensive financial planning and investment advisory services. Alex is a certified financial planner, a chartered financial analyst, and he leads the firm's investment management group. He's also a regular presenter for our firm, and he's going to be co-presenting with Judy during the Secure 2.0 webinar on May 2nd. And next Thursday, I believe, is our firm's next quarterly market update session. That's February 16th. So he's going to be presenting with Joshua Hahn, our senior investment analyst. Alex was also recognized as a top financial advisor by Bethesda Magazine, and he's frequently quoted in financial media outlets such as Kiplinger. So thank you once again for registering and for joining us. I'm going to turn it over now to our presenters.
Thank you, Joe. Appreciate that nice introduction. Welcome, everybody, to our webinar. Alex and I love the chance to speak to you. We're frequent presenters, as Joe mentioned, and this dovetails with our Social Security presentation, that we just did last month. And we really do want to help demystify the whole Medicare question. It can be complicated, so we're going to help you better understand the enrollment process. We're going to discuss the differences between traditional Medicare and Medicare Advantage, where we can't tell you specifically what is right for you. We can give you the tools so you know what to ask and what to think about when you're making that decision. Alex is going to be covering the relationship between Medicare and the federal health coverage. I'm going to be covering the Inflation Reduction Act and how its impact on Medicare in 2023 and also in future years. And then we're both going to put on our tax hats and talk about how can you try to employ some tax savings techniques to reduce the Medicare premiums that you pay. Okay, so just a little background. Medicare was signed into law by President Johnson in July of 1965, so it's been around a long time. In 1997, Part C, which is the Medicare Advantage part, was added. And in 2006, the Part D, which is the prescription drug coverage, was passed into law. Now, there are two trust funds. The Hospital Insurance Trust Fund, HI, is specifically just is the trust fund for Medicare Part A, and it is funded through payroll taxes. Both employee and employers pay 1.45% for a total of 2.9 on payroll wages into the Hospital Insurance HI Trust Fund. And the trust fund has some investment earnings as well. The second trust fund, the Supplementary Medical Insurance Trust Fund, SMI, covers Medicare Part B and D. And this trust fund is funded by Congress and by the premiums that all of the Medicare enrollees pay into the funds. It's expected that growth is going to be highest in the next 10 years due to the baby boomer generation. And just some fun facts for you. 64 million Americans currently are enrolled in Medicare. That's 1 in 5 in the US population. It's estimated to be 80 million Americans by the year 2030. And Medicare and Social Security represent approximately 40% of the federal budget. Now, those of you that may have listened to the State of the Union address on Tuesday night, and the Washington Post had an article today, and of course, you've heard me talk about it when we've had our Social Security presentations. The trust funds are in trouble. The Social Security Trust Fund is scheduled to run out the surplus in 2030, and the Medicare Trust Fund is 2028. That's 5 years from now. And what does that mean for retirees? It means that in 2028, the trust fund revenues are projected to cover only 90% of expenditures and less in later years. Now, you heard the president and the Republicans, they made their pact on Tuesday night. They're not touching Social Security and Medicare, but in my opinion, that is unwise, and I'm not going to get political here, but essentially, the longer we delay the fixes, the harder the pain is going to be. And I think that you'll hear Alex and I today, and we've talked about it in Social Security, taxes are going to go up. Income taxes are going to go up. Payroll taxes are going to go up. I mean, there's going to be additional costs in the future. It has to be. I mean, there's just no other way around it. So we're going to help you, think about some ways to maybe minimize that hit to you. So what are some fixes? Of course, delay entry date. I mean, 65, age 65, delay it to 68 or 69 or 70, but delay the entry date. Premium increases, reduced benefits, sadly. And there is some talk about an income wealth test. So specifically cutting Medicare, the eligibility to participate in Medicare for what is considered to be the rich. I could talk about this a long time, but we're going to go on to the next page.
All right.
Alex?
Well, thank you. Thank you, Judy. And thanks again, everyone, for joining us today. So where do you start? So we'll start with some of the basics here. So Medicare provides health care for retirees, and perhaps well, all of you know that, but there's still some misunderstandings. Specifically, it is not part of the Medicaid program. In fact, even though both of them do provide health care benefits to people, they're very different. Medicare is a federal program, and Medicaid is a state-sponsored program. It was one of the questions that was actually submitted to us prior to this webinar, so I'm happy to briefly address it here. But essentially, Medicaid is really for those who have very low income. That's really how you qualify for it. And in terms of Medicare, again, essentially everyone who turns 65 qualifies. In the US, it's really 99.9% of people who paid into the system. So when should you apply? You should apply at age 65 in most cases, or when your creditable coverage ends. And for most people, creditable coverage ends really means when you disengage your employer and or retire. And I will go over that in just a moment. So in terms of the application process or timeline, you actually have 3 months prior to the month when you turn 65, and then 3 months thereafter. So you have seven months total to apply, which is a pretty significant time to review your options and apply for the benefits that will be best for you. Now, at the end of your creditable coverage, you'll actually have 8 months to apply for benefits. Now, it's important here that for each 12 months that you delay, again, beyond your age 65, there's a 10% penalty on your premiums, again, for each 12 months that you're delaying, so multiply it by 3 if you delayed for 3 years. But that applies to the paid benefits only, Part B and Part D. Part A is free, and we'll talk about that more separately. Now, there's this exception to this rule, and it applies if you actively work and your coverage is provided, and that's important, by an employer with more than 20 employees. This exception also applies if your spouse is working for such employer and you're covered by his or her plan. So that's important. Let me make an example. Let's say you decided to retire earlier at the age of 62, and your spouse is still working. Let's say you're reaching your 65th birthday. You can still stay under his or her plan as long as, again, he is working for someone with more than 20 employees. And that actually leads me to one of the most common mistakes people make, and then they find out, and it's not all that pleasant to resolve it. Self-employed people, very specific example, or small companies with less than 5 employees in many cases. They have coverage, and let's say they like their coverage. They assume they don't have to switch to Part B and Part D just because they have that coverage. Well, that's true. You don't have to, but the penalty applies. And then if you decide to retire, let's say at the age of 70 or later, it's going to be a pretty significant penalty. So if you find yourself in that situation, hopefully you will not make that mistake. In terms of your initial application, that needs to happen on the Social Security website, www.socialsecurity.gov. What's important here, which is rarely a mistake, but sometimes more of a misunderstanding, you do not have to apply for your Social Security and Medicare benefits at the same time. And for those of you who participate in our previous Social Security webinar, it's unlikely to be the most optimal choice for you to begin with, meaning age 65. So again, be careful that you're not applying for both at the same time. Now, there are many other enrollment periods that may apply to you, and you don't necessarily need to memorize the slide. There's a lot more if you go on the Medicare website that explains why you would select each particular period. But just so you know, the annual enrollment period begins on October 15th and lasts all the way to December 7th. And essentially, it's for those who want to review and or adjust their coverage to make sure it meets your needs. And if you decide to take this approach, your new coverage will begin on January 1st. That is actually one of the recommendations we make to our clients. If you're uncomfortable, well, this would be a perfect time for you to review and make adjustments. There's the general enrollment period from January 1st to March 31st, and it applies to those who did not sign up when they were first eligible for coverage. You can enroll in parts A and B, and after you enroll for those, you can also add Part D and Medicare supplements or Medigap policies. You also have the Medicare Advantage open enrollment period from January 1st to March 31st, and that is where you can make one-time changes to your Medicare Advantage plan benefits, and Judy will talk about that separately. There are also several special enrollment periods, and I'll just mention 2 here. They apply when you move out of your plan's service area and you need to change your coverage, or when your employer provided plan ends. So again, perhaps you're still working for that employer, but that employer no longer provides any health benefits, so you'll have that special period to apply for benefits. So how does it work? How does Medicare work? And essentially you have two paths here. You have the traditional approach, and I'll cover that in just a moment. And then you have the Medicare Advantage option, which is what Judy will discuss. So under the traditional approach, you have Medicare Part A, which is free for most people. In practice, it's really free for everyone as long as you paid into the system for at least 10 years, if I'm not mistaken. And it covers hospital care, skilled nursing facility care. There's a limited coverage for that, hospice care, and limited at-home care. Medicare Part B covers doctor services, medical supplies, and preventive care. It's paid coverage and is based on your income. The lowest premium in 2023 is $170 per month. It can be significantly higher, and we'll talk about ways to reduce that later in our webinar today. The idea is to really cover roughly 80% of your health maintenance expenses by enrolling parts A and B. Medicare Part D provides prescription drug coverage, and your premiums also vary based on your income. It can be anywhere between $7 per month all the way to $99 per month. Plus, what we would frequently suggest, again, so that you cover that additional 20%, is that you apply for one of those Medigap or Medicare supplemental insurance policies. Premiums vary. These are private. These are offered by private insurance. There are 12 different programs that are available to you. So there's a long list for you to choose from. So again, this is your traditional approach, or you can take a different approach. Judy?
Yep. So option 2 is the Medicare Advantage. So we wanted to just make sure everybody understood it's the traditional approach, which is A, B, D, and the supplemental, or the Medicare Advantage plan. And that is why Medicare Advantage plans are gaining in popularity, because the original Medicare requires you to piece together those 4 plans, if you will. You have to research each one of them and kind of add up the costs of the 4 different ones. What are your deductibles? What are your out-of-pockets? What is your co-insurance? And then compare that to the Medicare Advantage plan. So Medicare Advantage is just kind of is easier for many Americans to understand. It's similar to employer-sponsored health insurance, certainly offered by the private health insurance companies. So it might feel a little bit more familiar as well to new retirees. Don't let that fool you though, because there's big differences between the two. I'm going to give you some considerations, but I just wanted to point out first some resources. When you decide to apply for Medicare and beforehand, take advantage of the medicare.gov .plan compare feature, and also take a look at your state health insurance assistance, otherwise known as the SHIP site, and that might help you decide. There are 3 phases of retirement that many retirement experts talk about. There are the go-go years, and actually you may be working full-time and not actually in retirement and still be considered part of the go-go years. You're active physically, mentally. There's the slow-go years, typically between the ages of 70 and 84, where maybe you're a little bit more stable and predictable. And then there are the no-go years, which is when you're definitely slowing down. And when Alex mentioned about the annual enrollment, I can't emphasize enough, as you go through these 3 phases of retirement, your needs are going to change, and you do want to not just make a decision to sign up and stick it with it for, throughout your 3 phases of retirement, but look at it each year and determine what is the right solution for you. Now, considerations, of course, health is going to be your primary consideration. Do you have any chronic illnesses? Prescriptions, how many do you take? What kind? Are they, name brands or not? How much do you have to pay for them? Coverage, doctors and hospitals. Do you prefer, in-network doctors or are you willing to pay the out-of-network costs that Medicare Advantage might require you to pay? Referrals are not necessary under Medicare, traditional Medicare, but they may very well be required under Medicare Advantage plans. Quality of care, your financial ability, are you able to pay self-insure, if you will, out-of-pocket costs? How comfortable are you with that? Traveling, that goes to the go-go years and maybe even the slow-go years. If you're going to be traveling abroad, you're not going to get coverage by Medicare or Medicare Advantage. There may be some Medicare Advantage plans that have some tweak to it, but under traditional, you'd have to buy the supplemental Medigap and find one that actually covers travel, or alternatively get travel insurance. But keep that in mind, and keep in mind where it is that you're going to be living. Maybe you have a second home. Maybe you live in the north and like to go to Florida or the south for the winter. Will your Medicare Advantage plan, if you're traveling out of state, will it cover you? Will it provide you access to the doctors in the network that you need without charging you a lot of out-of-plan costs? So those are very important considerations. Okay, next is the two paths. Okay, so traditional Medicare, as Alex said, is Part A. It's the hospital, hospice, nursing. Part B, the doctor's visits, and Part D, the prescription. Then you got to add in your supplemental insurance. And it's best, generally speaking, if you don't mind higher premiums. You seek freedom to select doctors, hence my comment about not having to have referrals. You prefer lower out-of-pocket costs, and you maybe are managing a chronic condition. According to Kaiser Family Foundation, 52% of enrollees choose Medigap or traditional Medicare plans in America. The Medicare Advantage, Part C, as I said, is more of an employer-sponsored health insurance. It does generally include your prescription drugs. It often will also provide vision and hearing and other services. And then it's best really if you're more familiar, if you feel you like the employer-sponsored plan, you're flexible in your service providers. You're seeking cost efficiency and really just catastrophic insurance coverage, and you don't mind paying copays and deductibles and managing your costs, and essentially taking personal responsibility for your own medical costs. And about 48% enroll in Medicare Advantage, although that number has been growing. Considerations, the 2022 Fidelity retiree cost estimate for an average couple at age 65 can expect to spend $315,000 on healthcare expenses in retirement. So it's very important to consider, what your actual health needs are going to be, and how financially independent are you to be able to cover some of the out-of-pocket costs, and really, map out which of these two paths is going to be best for you. And one last comment on that. One article I read on Kaiser said 99% of doctors do accept Medicare. So sometimes people say, oh, nobody accepts Medicare anymore. Well, they do. And 83% of primary care physicians accept new Medicare patients. So there are plenty of physicians out there that do accept Medicare, and they will continue, I think, because of the growing population that is entering retirement. Okay, let's talk about what's not covered in parts A and B. Long-term care, that's critical, and that's where in the Fidelity report that I was talking about, $315,000 in expenses. Well, long-term care is going to be a big piece of it. So if you don't have long-term care insurance, you might think as to whether or not that is an option for you now, and or self-insuring for long-term care. Dental care, it's not covered. Eye exams related to prescribing glasses, dentures, cosmetic surgery, acupuncture, hearing aids, although that's been a change, and private duty nursing. Couple other exceptions I wanted to mention: inpatient mental health care. If you have someone or you are in needing psychiatric hospital care, Medicare is limited to 190 days, lifetime days, 190, that's it. And that's what it will cover. Skilled nursing, days 1 through 20, there's zero copay. Days 21 through 100, the patient will pay $200 a day starting in 2023. And days beyond 101, the patient pays all the costs. So Medicare, that's why the supplemental is so important. If you're going to be going the traditional route, you've really got to have that catastrophic coverage, unless you have a lot of assets that can help you cover. So in terms of this slide, part A, which is on the right, remember that is the hospital, nursing facility, hospice care. It starts with meeting a deductible, and in 2023, the deductible amount is $1,556 per each benefit period, which begs the question, what is a benefit period? Well, a benefit period begins the first day of inpatient hospital admission, and it ends 60 days after release from the hospital. After that point in time, the new benefit period starts. So it's $1,556 deductible for each benefit period. Zero coinsurance for days 1 through 60, 389 coinsurance if you're in the days 61 through 90, and then days 91 and beyond, there's a 778 coinsurance for each lifetime reserve day. And there's a maximum of 60 lifetime reserve days. They allow you to extend the benefit period, but 60 is the maximum lifetime reserve. Part B, which is in the middle of the slide, which is the doctors and medical supplies, $233 deductible per year, which really is a bargain. But then you pay 20% of all of the Medicare approved amounts, and keep that in mind, Medicare approved amounts. So again, the need for supplemental Medigap if you go the traditional route. Next slide, please. Okay, the donut hole. The donut hole is for prescription drugs. And the way the donut hole works is in 2023, you're going to first have the deductible phase. So you're going to pay $505 of deductible for prescription drugs. Once you've met the deductible, you enter in what's called the initial coverage phase. And there's a copay or coinsurance that you have to pay depending on the plan that you have for a total of $4,666. After that, you would enter the coverage gap phase of the donut hole, and there you'd have to pay 25% of the drug costs until your out-of-pocket limit is $7,400 in 2023. And once you've reached the $7,400, you enter the catastrophic coverage phase, and you pay 5% of the drug price. Now, just in summary, I don't know if anybody was taking notes, but if you, from the previous page, Part A deductible, we said was $1,556. Part B deductible, $233. Part D deductible, $505. So that's $2,294 deductible in 2023 under traditional Medicare. Alex?
All right. So how does Medicare work with FECBA, or Federal Employees Health Benefits Program? And this is actually one of the common questions or considerations we discuss with our clients. A good quarter of our clients are actually either current or former federal employees. So if you're one of them, then certainly this information is for you. For federal employees and retirees who are covered by FECBA, which is of course essentially all of them. If you're entitled to Part A without paying the premium, essentially if you're about to turn 65, we recommend that you enroll in it, even if you're still working. Again, there's no premium for Part A. Perhaps it will cover some of your hospital-related expenses that your FAGBA plan may not cover, such as deductibles, coinsurance. And again, mostly it's the fact that you don't have to pay anything for Part A. So that's simple. Now, for parts B and D, it's a little more challenging than that. I will start with Part D, which is actually not all that challenging. So for federal retirees, or again, employees, they're not likely to benefit from enrolling in Part D because they already have comprehensive drug coverage through their FAGBA plan. Now, there's one potential exclusion to this suggestion, and it only applies, let's say, in a few cases. For those retirees with limited resources, they may still want to consider enrolling in Part D if they qualify for extra help under the Part D program. Again, very uncommon, but I thought I would mention that. Now, again, if you're still working, or perhaps you're already retired, or if you're covered by your spouse's FAGBA plan, you don't have to enroll in Part B when you turn 65. But depending on your situation, and specifically depending on your FAGBA plan, you may still benefit from enrolling in Part B by receiving almost complete coverage for all medical expenses. And to show you what I mean, we have a couple of case studies here. And again, your situation can be very different from it, but just so you know where I'm coming from. These are, by the way, real cases. We simplified them somewhat for our webinar today, and of course, we changed the names here. So Jane is in retirement. Her only income is her Social Security and FERS pension, and FERS is a federal employee retirement system pension. She has limited investment assets, and as a result of that, her investment income is limited. At the same time, her healthcare needs are significant, including a chronic condition. So in her case, based on her level of income, and we'll talk about different Part B and Part D brackets in just a moment, her Part B premium is going to be $230 per month. So when we had this conversation with Jane, and we took into consideration, again, her income, her expenses, her personal preferences, our suggestion was for Jane was to sign up for Part B in addition to FAGBA. Why is that the case? Well, $230 per month, even though it's not, nothing, but it's manageable in terms of her expenses. So essentially it becomes a permanent part of her budget. But at the same time, this approach essentially removes this additional risk that at least some of her medical expenses are not going to be covered by FAGBA. Plus, as I mentioned earlier, since she is going to apply at her age 65, in this case, the 10% penalty will no longer apply. And one important piece, I'll emphasize it here, this decision needs to be made prior to your 65th birthday or prior to your retirement date. The second case study here we have is Jason and Tammy McNeil. Now, their income in retirement is much more significant. They have Social Security, pension, and also some rental income. They have significant investment assets. So as a result of that, they have significant investment income. Their health needs are average. They certainly see some doctors every so often, but overall, their needs are average. Now, based on their income, based on their joint income to be specific, each of them would have to pay $428 per month. And again, that's per person, which would put them in the fourth income bracket for Part B and Part B purposes if they decide to sign up. So when we had this conversation with them, the conclusion was that perhaps for them, it would really make sense to stay only on FAGBA because it's already comprehensive. They're healthy, so perhaps they will not need that much, health care in the future besides, again, what FAGBA provides. And then essentially for them, they would reinvest their unspent premiums as part of their overall investment strategy. In this case, by the way, we're talking $428 per month, again, per person per year, which is almost actually more than $10,000 per year. So in some sense, it creates this additional buffer for them if / when they need additional coverage. Judy?
Thanks, Alex. So the Inflation Reduction Act of 2022 was signed by President Biden last August. And you know, the American population really hasn't felt any results from it because it really didn't take effect until this year. One of the key aspects is this cap on insulin products. That's effective January of 2023, a $35 a month cap. I did a little reading, and according to the American Diabetes Association, individuals with type 1 diabetes need on an average 2 to 3 vials per month of insulin. And the average cost can be $1,000 or more for those that have no insurance or have kind of inadequate insurance. So we're talking about a very significant cost savings for those retirees that happen to have diabetes and need insulin products. Big change here. Eliminating the 5% coinsurance for the catastrophic coverage in 2024, and we're going to show you a revised donut hole in the next slide. And then capping the out-of-pocket spending at $2,000 in 2025. That's a big savings again for retirees, and it's estimated the cap will be roughly $3,250 in 2024. So definite savings coming down the road. And I'll just mention to keep that in mind when you go through the annual renewal, because maybe this will be a game changer in terms of which plan you want to be in. The fact that there are now caps on these out-of-pocket costs and the catastrophic co-insurance. Free vaccinations for all retirees. And then this is interesting. One of the questions that came in to us in preparation for this webinar was about inflation. Well, the Inflation Reduction Act will actually require the drug companies to pay back the federal government if they raise the drug prices higher than the rate of inflation. Very interesting. So, that's essentially locking in the cost of rising drug prices that Medicare has to pay to inflation. Now, you might ask, how is this all being paid for? And there is a 15% minimum corporate tax assessed on what's considered the ultra large corporations, and those are corporations with $1 billion of revenues a year. So it's a minimum 15% tax that's going to be assessed, and a 1% excise tax on stock buybacks by public companies. You may have heard President Biden mentioned that on the State of the Union address on Tuesday, that it's anticipated that some very large companies are using their excess profits and cash to make stock buybacks. And this is one way to basically, at least, they can't say it won't happen, but there'll be a 1% excise tax if it does, to pay back in to the federal government. Okay. Couple other items on the Inflation Reduction Act, the renegotiation of certain drug prices. So I looked this up, and the way this is going to work is the Center for Medicare Services, CMS, they're going to publish a list of the first 10 drugs that they want to renegotiate by September of this year. And then they're going to negotiate with the drug companies for 1 year. And by September of 2024, they're going to publish the list of the negotiated drug prices to be in effect January of 26. Now, I don't know, exactly what 10 drugs those are going to be, but again, if you're a retiree and you have some very expensive drugs, annually you'll want to look at this list to see if the actual price for drugs is going to be coming down that you rely on. And I think it's going to be very interesting, the impact on this. There's a lot of discussion back and forth that those not covered by Medicare are going to end up having to pay more for certain drugs because of this act. But we'll see. You know, time will see. There's a delay in implementation of the drug rebate rule, which was basically a rule passed under the Trump administration to actually give some money back to the drug companies, and that never got implemented. So it's really not much of a change. And then the Inflation Reduction Act does expand eligibility for certain low-income individuals. The CBO, which is the Congressional Budget Office, estimates that the drug provisions, savings provisions of this act will reduce the federal deficit by $237 billion over the next 10 years. Okay, let's go to the revised donut hole. Here we go. So this is the same slide that we saw before, but what we're doing is we're showing the differences for 2024 and 2025, again, only for prescription drugs, Medicare Part D, and how it's going to change because of the Inflation Reduction Act. And really the summary is, if you see down there on 2024, remember there was a catastrophic coverage phase, and the out-of-pocket limit was $7,400. That's the limit in 2023. Well, that's going to go down to $3,250 in 2024. That's a savings of $4,150 per retiree that ends up having to fall under this catastrophic coverage phase. And in 2025, it further goes down to $2,000. So if we compare $2,000 to the $7,400 in 2023, that's a savings of $5,400. So Inflation Reduction Act is a game changer for retirees. It will absolutely cost retirees less money. And as I said, I explained how it was going to be paid for, and time will tell to see, you know, how popular it is as it gets implemented and what the repercussions are.
All right, so IRMA, or income related monthly adjustment amount. So we'll talk about different ways to essentially reduce your Part B and Part D premiums, and this is where I really suggest that you pay attention, because again, knowing this information perhaps at the very least will prevent you from some unpleasant surprises in the future because of just how it works. And specifically, if you plan ahead of time, perhaps you'll even be able to again reduce your premiums, in addition, of course, to achieving the overall tax efficiency. So Medicare Part B and Part D premiums, as we discussed earlier, are means tested or based on your income, and your premium is determined by your prior modified adjusted gross income. There's a 2-year look back, which is what confuses many people. So to be specific, for your 2023 premiums, they'll actually be based on your 2021 income. And it's interesting, we got many questions from our clients specifically last year, and I'm expecting more or less the same number of questions this year, because as you perhaps recall, 2020 and 2021 were very good years for the markets. So there were some significant capital gains generated, specifically in some accounts. So that's essentially what triggered this higher premiums. So just to make sure we're on the same page, so if you're single and your income in 2021 was $97,000 or less, your Medicare Part B premium would be $165 essentially. You would be in the first bracket for Medicare purposes. If your income in 2021 was $183,000 or more, but less than $500,000, your Part B premium in this case would be significantly higher. It would be $527 per month. Notice that there is this $30,000 difference between different brackets up until the 5th bracket, but then it essentially stays at $500,000 and above. For those who are married and filing jointly, it's a similar situation, similar approach, but the difference between the brackets is $60,000, essentially double of what you have for single people. So that is essentially what you have to work with, and the idea is as much as possible to keep you in the lowest bracket possible. So how can we accomplish that? So again, the overall objective is pretty clear here, is to remain within the lowest possible tax bracket to minimize your Part B and Part D premiums. And in some sense goes without saying, but as you go through this approach, perhaps it will also help you with your overall tax situation. And perhaps those benefits will be even more significant, but today we're focusing on Medicare. So some of the planning ideas for you to consider. So let's say you have a pension or some kind of cash balance plan at work. So what many people would, at least initially, consider doing is annuitizing that benefit so that they receive X dollars for life. Let's make it $30,000 just to make my example very clear for life. Well, that's great. But again, by selecting this approach for Medicare purposes, you're essentially immediately putting yourself in the next bracket. And as a result of that, your Part B premiums will be permanently, Part D as well, will be permanently increased in the future. Now, if you decide to take the IRA rollover approach, now you have more choices in terms of your investment options. You have more choices in terms of when you would be distributing the funds. So, keep that in mind. Now, for those who have significant amounts in their pre-tax accounts, IRA and 401k accounts, consider doing Roth conversions to minimize your required minimum distributions, because your RMDs are actually one of the top triggers for a higher Part B premiums. In some cases, by the way, they can move you up, not just by one, but even two brackets. So now this strategy is particularly powerful if you do it over multiple years, 3, 5, even 7 years, which is, by the way, why we always recommend that our clients begin planning for their retirement, 5 to 7 years prior to the actual retirement date, because that gives them enough time to do all of this. But keep in mind, and I'll make this specific example, let's say you're working on a Roth conversion at the age of 63. Well, chances are, especially if it's a significant conversion, it will impact your Medicare premiums at the age of 65 because of the 2-year look back. And again, remember the brackets, there's a $30,000 difference. So if you convert more than that, again, chances are it will put you in the next bracket. Now, the next one is somewhat situational. The idea of rolling over your IRA into your 401k account to eliminate your required minimum distributions if you're still working, but it can be quite powerful. We do have actually quite a few clients who continue to work at least part-time, and they still contribute into their 401k accounts. So if you roll over your IRA account, well, that again eliminates your RMD, and as a result of that, hopefully your Part B premiums will also be less. What are some of the common trigger events? And again, perhaps in some cases you cannot really prevent this from happening, but at the very least you can be aware of it. And again, in some cases, hopefully you can plan better. So capital gains from asset sales. So a perfect example of that is sale of your home. And let's say there's a significant capital gain that happens as a result of that. $250,000, maybe $500,000. Well, that will immediately put you essentially in the highest bracket for Medicare purposes. Now, in this particular case, it's very unlikely that you would succeed if you decide to appeal this decision. But there are other situations with rental property specifically, where filing an appeal can help you. One specific example actually helped one of our clients. She used to own a rental property, so it used to generate some income. She sold it, but as a result of that, there was a capital gain reported in her tax return, but she also lost her income. So on the basis of her lost income, we helped her file this form, and essentially her Part B premiums were returned back to where they used to be in the prior year. Now, if you have significant taxable capital gains coming from your investments, that frequently happens when you're changing your strategy. Again, what would be an example of that? When someone perhaps panics in times of market volatility, decides to sell most or perhaps even all of his or her stocks, and perhaps those stocks accumulated significant capital gains. Well, that results again in additional taxes, but also impacts your Medicare premium. So keep that in mind. If you need to make significant adjustments to your strategy, more often than not, you should do it over multiple years, or perhaps identify ways to offset those capital gains. Significant taxable investment income. A good example of that is when people keep a lot of their dividend-paying stocks in their taxable accounts. So it's great that you have that income, but again, it's taxable to you, and it also impacts your Part B premiums. Perhaps there's a way for you to shift some, or perhaps even all of that income into your tax-deferred accounts. So again, to show you how this works in this simplified cases. So we have John and Janet here, and their overall situation, let's just say, is essentially identical. Both of them are in retirement. Their finances are more or less the same. So John here has $75,000 of pension and Social Security income. His required minimum distributions, or RMDs, are $25,000. His taxable dividends are $15,000, and his total taxable capital gains are $30,000. So as a result of that, his total taxable income is $145,000, which puts him in the third income bracket for Medicare Part B premium purposes, which happens to be $329 per month. Now, Janet here, who's again in more or less the same situation, is a planner. So she planned ahead, and she made some adjustments in this case in her portfolio. So as a result of that, again, her income and her required minimum distributions are the same. You essentially have no control over those, but her taxable dividends, essentially are a third of what John is paying, because she shifted her taxable dividends into her pre-tax accounts. She's paying less in taxable capital gains because she uses more tax efficient investment options, and her overall approach is much more thoughtful. And as a result of that, her total taxable income is $120,000, $25,000 less than for John. And as a result of that, she's paying only $230 per month in Part B premiums. That's a significant saving. That is $1,200 per year. And I'm going to say essentially for life. So over the next 10 years, her savings are going to be $12,000 or more. And that is only on Part B premiums. There's also Part D. Plus, of course, from the overall tax perspective, someone who has $25,000 less in taxable income, they're probably saving themselves, $7,000 to $8,000 in taxes each year. So the bottom line here is really, it makes sense to plan ahead, especially again if you're careful with what you're doing. All right, so that's what we have. And again, please ask questions. I noticed we received quite a few in our chat box, but we'll cover a couple of frequently asked questions, and then again go over
hey,
as
Alex,
many
can I
questions
just
as we can.
make a comment
Yes.
on your prior slide? So,
Yes.
The Tax Cut and Jobs Act that was passed in December of 2017, that's what reduced our income tax brackets. And that is going to sunset in 2025. So kind of going back to where we started today's presentation, taxes are going to go up. They're going to go up in 2026, one way or another, to fund the deficit, to fund Medicare, Medicaid. And so we've been doing a lot of Roth conversions, particularly with the market down. So not only are individuals paying at a lower income tax bracket than they will in the future, we believe, we're expecting, but they're also paying it on a reduced amount. And then the growth in the Roth is tax-free once it's converted. The price of that is higher Medicare premiums, and that's something to be taken into account. But this is an important tool, and there's other tools too. IRA contributions to donor advised funds, and other, trust, charitable remainder trusts and so forth. These are the things that Alex and I like to do in terms of, tax and investment planning for individuals to help save on their future taxable income, which will ultimately come into play with these Medicare premiums.
That's right. All right, so a couple of, again, frequently asked questions. Can Medicare be used to cover family members? Short answer to that question is negative. Medicare is a personal benefit, so it's designed to cover each retiree individually. Now, there are some circumstances when that would apply, but for the vast majority of people, it's an individual benefit.
So I'll take the next question on the health savings account. We got a lot of questions on this, and one of the questions was, well, should I just go ahead and pay the penalty? So let me back up on this for a second. In order to have a health savings account, you have to have a qualified health insurance plan. It has to be a high deductible plan, and the minute that you enroll in Medicare, it disqualifies you from making health savings account contributions, and not just you, but your employer as well. And Medicare goes back 6 months. So what happens is when you report your health savings account contributions on your personal income tax return, you will not be qualified to make those contributions or have the employer have made those contributions. And consequently, they will be treated as an excess contribution subject to a 6% excise tax. Now, the question to us, the chat box was, well, should I just pay the 6%? 6% of $1,000, sure, I'll pay that and still be able to get my health savings deduction. Well, no, because that excess contribution every year is subject to an excise tax until it's removed in perpetuity, along with any investment income that might be on it. So the short answer is you do not want to participate in a health savings account if you are enrolling in Medicare. And that means that you may want to put off enrolling in Medicare because you are working for an employer that has more than 20 employees, take that into consideration when you make that decision, even though Part A is technically free.
Thank you, Judy. That was a very comprehensive question, but it's one of the top questions, actually top mistakes. All right, so we have 4 minutes to go. I feel like we should really push it, maybe like 12:05, because we have a lot of questions. I'll start with the chat box here. Again, I'll read your question out loud, but I will not mention your name for privacy purposes. Are you automatically enrolled in Medicare when you turn 65? Question mark. If you turn 65 while still working, do you have to decline enrollment? So happy to, I'll address this question. It was in one of my slides. So no, you're not automatically enrolled in Medicare when you turn 65. This is something that you need to do. And in terms of you declining your coverage, I'm assuming that refers to your coverage at work. That is also not automatic. There are scenarios where, again, you continue to stay under your employer's plan and you only apply for Part A, which is perfectly fine. There are scenarios where you would want to switch to Part A and Part B, and perhaps Part D, or maybe even Medicare Advantage. An example of that would be if your employer's plan isn't that great, or perhaps it's not subsidized by your employer that much, meaning you're covering most of the coverage, and vice versa. Some plans can be quite expensive in terms of their premiums, but if your employer is covering most of it, then perhaps you would want to stay on that plan.
And just to add to that question, yeah. So that was one on Alex's one of the first slides about how to enroll. So you enroll at socialsecurity.gov, and just remember you don't have to enroll in Social Security and Medicare at the same time, but that's where you enroll for Medicare. And I recently attended a symposium where we learned that socialsecurity.gov is implementing the ID.me, identity theft technology. And the IRS.gov has ID.me. I went and got my own identity theft pin. It took about 3 hours to do it. But that's something, don't wait till the last minute to enroll in Medicare, because you've got 3 months before and after. And you might want to just get familiar with the technology, get your ID.me account so that you can enroll when it's time to enroll.
Sounds good. Here's the next question. And Judy, are you okay if we go 5 minutes over?
Sure.
12? I feel like since we got so many questions here, if you're enrolled spouses in your spouse's employer plan, do you need to enroll in Medicare at 65 window? Okay, I believe I understand this question, and this was also covered on one of my slides. The answer is negative. Mostly, in most cases, if your spouse is still working and he or she is covered by his or her employer plan, and the employer has more than 20 employees, you don't have to switch to Medicare. Now, you don't have to switch to Medicare at all, even if it's less than 20 employees. But in that case, there's going to be a 10% penalty. So that's my answer to that question. Judy, anything to add?
No.
Okay, here's one actually from, should we, it's actually the same question. I'm glad we already covered this. Yeah, there was a very similar question to that was submitted to us prior, so I guess we'll skip on that. Here's the next one. I'm 73 and working. I'm registered for Medicare Part A, but not Part B. I have a good insurance plan at work. There's no question here, but I believe I understand the question. So if you like the plan, and again, you have more than 20 employees, this company has more than 20 employees, you do not have to switch to Part B. There's not going to be a penalty if you decide to switch next year when you turn 74. Here's another one. Do either options offer dental coverage? Judy? I believe that was in one of your slides.
The Medicare Advantage has various different supplements that you can purchase, and so take a look at that. Traditional Medicare does not, to my knowledge.
That's exactly my understanding. Here's the next one. What's the average cost? Please repeat it. And this is for you, Judy, when you were talking about the average healthcare cost for retirees. It was 300,000 something.
Well, that was for a couple retiring at age 65, and that is really drawing from the need that probably one or both might need to have some long-term care needs that are not covered by Medicare. But the actual costs I mentioned when you added up all the out-of-pocket deductibles, I believe it was $3,000 a year just for out-of-pockets under the traditional. And so you want to, compare that. You have 2,294. Want to compare that to what the deductible would be if you found a Medicare Advantage plan that you were happy for in your area, and then compare the co-insurance amounts that might be required.
Thank you, Judy. So how about two more questions here? Is it a 2-year look back to the 2 years before you were eligible, or the 2 years before you sign up for parts B and D? So that is 2 years before you were eligible. So the first look back happens at your age 65. So it would be your Part B and Part D premiums would be based on your income at age 63, and then each year it shifts by year. So at 66 it would be at 64, at 67 it would be your income at age 65. Do you want to describe it any differently?
Yeah, no. So every year, really, you're wanting to, be mindful of your modified adjusted gross income for purposes of the Medicare premiums. And as Alex mentioned, capital gains. And 1 year, I know Vanguard issued all these capital gain at the end of the year. And people were caught off guard with what we'll call paper gains that they had to pay tax on. Well, next thing you know, they also would be subject to higher Medicare premiums. And the waivers don't work for regular ordinary capital gains or even sale of a house. It would have to be more like a business transaction or change in jobs, or something that was that you could appeal to have the to use current situation as opposed to your prior tax return 2 years ago. We've tried.
All right, so final question, I guess, but of course, if we're not addressing any of your questions, please feel free to reach out to Judy and myself. Are the Medicare Part B premiums calculated each year for retirees? So if your income goes down, the premiums will go down and vice versa. Correct. Well, that's correct. It's just there's a 2-year look back. But yes, I mean, it's if you want to keep it that simple, if you retire with, I don't know, $250,000 of income and then each year declines to, let's say, 50,000, well, your Medicare Part B and Part D premiums will also decline over time. So it's calculated each year with a 2-year look back.
Alex,
All
let's
right.
go to our upcoming
Yes.
events. Yep. So Alex is going to be presenting his quarterly market update next week, and then another one in April. If you want to, stay tuned about what his thoughts are in terms of the current investment update and financial considerations, please tune into that. There is a webinar in March on buying and selling a home and the top planning ideas to keep in mind. I don't know, Alex, if you want to say anything further on that. And then the Secure Point 2.0, we have moved that back to May 2nd, but there have been big changes in terms of delayed retirement dates and so forth, not retirement dates, IRA distribution dates and so forth that we'll be covering and planning ideas under the new Secure 2.0 legislation in a couple months.
Thank you, Judy. Yes, very quickly about our March 9th webinar. It's going to be with Jan Brito. He's one of the top real estate brokers in the area. So we'll talk about, again, some of the top planning ideas if you're deciding to buy or sell your homes. And she'll also provide a very detailed update, actually, on the housing market in the area. So for those, again, who are interested in the subject, it will likely be very, very productive webinar. Yeah, so again, if there are any questions that we were not able to address for you today, feel free to reach out to Judy and myself. We'll certainly be happy to address them for you.
Thank you for attending. Appreciate it.
Thank you, everyone.
Have a great day. Take care. Bye-bye.